For decades, people were told one simple story: work hard, pay into the system, retire in peace. It sounded like a contract carved in stone. But what if that promise was never truly guaranteed? What if the pension system, the safety net meant to protect millions of retirees, was built on assumptions that no longer exist? What if the math stopped working years ago, but nobody wanted to admit it? Across the world, governments are quietly raising retirement ages, pension funds are freezing benefits, payments are being reduced, and younger workers are being told to contribute more for less in return. So here's the mystery we're solving today: why is a system that worked for generations suddenly breaking down? And more importantly, was this collapse inevitable from the very beginning? To understand why pensions are failing today, we have to go back to where the system was born and uncover the hidden weaknesses baked into its foundation. The modern pension system didn't appear because governments were generous. It appeared because societies were changing. In the early 1900s, most people didn't retire. You worked until your body couldn't anymore. Families supported elders. Communities shared responsibility. There was no formal safety net. Then industrialization changed everything. People left farms for factories. Cities grew. Families scattered. Suddenly, millions of elderly workers had no support system when they could no longer earn a wage. Governments stepped in. Germany introduced one of the first national pension systems in the late 1800s. Other countries followed. After World War II, pensions exploded in popularity. Governments and large corporations began offering guaranteed retirement income. It was sold as progress, stability, security, and for a while, it worked beautifully. Why? Because the world at that time had three powerful advantages. 1. Young populations, many workers, few retirees. 2. Rapid economic growth, expanding productivity and wages. 3. High birth rates. A constant flow of new contributors. These conditions made pensions look unstoppable, but hidden beneath this success was a fragile structure that depended on one dangerous assumption: that the future would always look like the past. There are two main pension models. Money is invested and grows over time. Your retirement depends on market returns. Today's workers fund today's retirees. There is no giant vault of money waiting for you. It's a continuous transfer of cash. Most public pension systems chose the second model. Why? Because it was politically attractive. Governments could promise generous benefits without immediately raising taxes. Future workers would pay the bill. It was the ultimate delayed cost strategy. At first, it looked genius, with many workers supporting few retirees. The math worked, contributions were small, benefits were strong, but this model created a ticking time bomb, because once demographics shifted, the entire structure would begin to crack. And that shift was already starting. From the 1950s through the 1980s, pensions became sacred. Retirement ages were set low, benefits increased, politicians competed over who could offer more generous payouts, companies promised lifelong pensions to attract workers. People began to build their entire life plans around one assumption: my pension will be there. But something important was happening in the background. Life expectancy was rising. Medical advances allowed people to live decades longer than previous generations. Retirement, once a short phase at the end of life, turned into a 20 to 30-year financial obligation. At the same time, birth rates started falling. Families had fewer children. The worker-to-retiree ratio began shrinking. That meant fewer contributors and more people collecting payments. The system still functioned, but only because governments kept expanding it with debt, optimistic growth forecasts, and creative accounting. The cracks were forming. They just weren't visible yet. By the 1990s and early 2000s, pension systems faced their first real stress test. Three major forces collided. Every year, more retirees entered the system than left it. What used to be 5 workers supporting one retiree became 3, then 2, and in some countries, nearly 1-to-1. This changed everything. The same contributions now had to stretch much further. Post-war economic boom slowed down. Productivity gains flattened. Wage growth weakened. Pension systems were designed assuming strong growth forever. That assumption failed. To compensate, pension funds chased higher returns in stocks, real estate, and complex financial products. This made pensions dependent on market performance. When markets boomed, The illusion of stability returned. When markets crashed, hidden deficits were exposed. And then came the moment that pulled the curtain back. The global financial crisis wasn't just a banking collapse, it was a pension earthquake. Suddenly, investment portfolios lost massive value, government budgets exploded with bailouts. Tax revenues dropped, pension funding gaps became impossible to ignore. Many funds realized they were dramatically underfunded, not by millions, by billions, and sometimes trillions. This forced painful decisions: raise retirement ages, reduce future benefits, freeze cost of living increases, increase worker contributions, but instead of fixing the core problem, many governments chose a familiar strategy: delay. They restructured numbers, adjusted assumptions, spread costs across decades. The public was told everything was under control, but behind closed doors, policymakers knew something dangerous. The system wasn't broken temporarily, it was structurally unstable. And the worst phase hadn't even arrived yet. Most people think pensions are failing because governments ran out of cash. That's only half the story. The deeper issue is this: pension systems depend on trust, demographics, and political promises. When any one of those collapses, the entire structure weakens. Younger generations began losing faith. They were paying more into systems they doubted would exist when they retired. Governments faced impossible choices: protect retirees today or protect the economic future tomorrow. And inflation, quietly eating purchasing power, made every promised payment worth less in real terms. This is where the story becomes truly uncomfortable. Because the final stage of pension failure doesn't happen suddenly, it happens slowly, quietly, through policy adjustments, inflation, erosion, benefit reforms, and delayed retirement ages. And most people don't realize what's happening until it's too late. We uncovered the uncomfortable truth: pension systems were built on demographic and economic assumptions that no longer exist. They depended on endless population growth, rising productivity, and political discipline. None of those conditions survive today. Now we move into the most dangerous phase of the story. Because when systems stop working, they don't collapse loudly at first. They adjust, they rebrand, they reform. And that's where the real damage begins. When pension math stopped working, policymakers faced a brutal choice: cut benefits and face public outrage, or slowly change the rules so people don't notice until decades later. Most chose the second option. Here's how it happened. Originally, retirement ages were set when life expectancy was far lower, but instead of redesigning the system entirely, governments simply pushed retirement further away. 65 became 67, 67 became 70. Early retirement penalties increased. Full benefit eligibility moved further into the future. On paper, this looks reasonable. In reality, it does something deeper. It reduces the number of years people collect benefits and increases the years they must work. It's not a fix, it's a survival tactic. Workers were told to pay their fair share. Contribution rates rose, employer obligations shifted, payroll taxes increased. At the same time, benefits were restructured. Lower payout formulas reduced inflation adjustments, new eligibility restrictions, benefit caps. The system slowly flipped from generous support to minimal survival income. The promise changed without officially being broken. Governments didn't need to cut payments directly. Inflation did it for them. Even when pensions rise nominally, they often fail to match real cost of living increases. Over time, retirees discover something painful: their checks arrive on time, but buy less every year. This isn't accidental. Inflation reduces the real value of long-term government obligations. It's the easiest political escape route. Every few years, new solutions are announced, but most don't address the core problem. Let's break down the biggest failed strategies. Pension funds began taking more risk. They moved away from safe bonds and into stocks, real estate, private equity, high-risk assets. This created short-term gains during market booms, but it also created massive exposure during crashes. When markets fall, pension funding gaps explode overnight. Risk became the substitute for sustainability. Some governments simply borrowed money to pay pensions. This pushed the cost into the future, but debt carries interest, and as national debt rises, budgets tighten. Eventually, borrowing becomes its own trap, the most dangerous strategy of all, assuming future workers will carry a heavier burden, but younger generations face higher living costs. Lower wage growth, housing crises, student debt, job instability, the willingness and ability to support older pension systems is collapsing. This creates generational tension. And that tension destabilizes political support for pensions themselves. If this story feels familiar, it's because we've seen it before. Large systems always follow the same cycle. Phase 1, expansion. Promises increase, benefits grow, optimism dominates. Phase 2, stress, costs rise, demographics shift, growth slows. Phase 3, adjustment, rules change, burdens shift, inflation erodes value. Phase 4, trust breakdown, people stop believing the system will protect them. We are now entering Phase 4. Across the world, workers doubt retirement systems, governments struggle with funding gaps. Pension funds warn of sustainability risks, retirement ages keep rising, private savings are replacing public guarantees. This isn't coincidence, it's structural repetition. Even as evidence mounts, many people cling to the pension promise. Why? Because the idea of guaranteed retirement security is emotionally powerful. It represents safety, stability, dignity. Admitting it's failing creates anxiety, so people choose denial. They assume reforms will fix everything. They assume governments will step in. They assume someone else will solve the problem. But history shows something uncomfortable. Large financial promises rarely survive demographic reality. Here's the truth most institutions won't say clearly. The pension era is quietly ending. Not instantly, not dramatically, but structurally. Retirement responsibility is shifting from governments and employers to individuals. This means more personal savings required, more financial literacy needed, more exposure to market risk, less guaranteed income whether people like it or not. This transition is already happening. Those who adapt early protect themselves. Those who wait discover the change too late. Pension collapse doesn't look like a single disaster headline. It looks like smaller increases than promised. Higher retirement ages, lower purchasing power, more work years, fewer guarantees. By the time the public fully realizes what's happening, the structure has already changed. And reversing it becomes politically and economically impossible. Let's bring this together with clarity. The system wasn't designed for aging populations and low birth rates. The math stopped working. No political reform can change population structure. Even when payments continue, purchasing power doesn't. Inflation quietly reduces obligations without public outrage. The era of guaranteed lifelong government retirement is fading. Those who depend entirely on pensions face increasing uncertainty. Here's the uncomfortable question you must consider. If pension systems are already struggling today, what happens when even more people retire over the next decades? The pressure doesn't decrease, it accelerates. This isn't a temporary crisis. It's a structural transition. And history shows that those who prepare early survive financial shifts far better than those who rely on promises. Now the decision is yours. You can ignore this information and hope the system protects you, or you can start learning how money actually works, how retirement systems really function, and how to build financial resilience in uncertain times. If this breakdown helped you see the bigger picture, like the video to support serious educational content. Subscribe for more deep financial storytelling and economic explanations. Comment below. Do you trust pension systems to survive the next 30 years? Because the future of retirement isn't being decided quietly, it's being rewritten right now. And the only question left is,